Is America heading for a fiscal crisis that could shake the world? Bridgewater founder Ray Dalio sounds the alarm on the U.S. budget deficit, warning there's a greater than 50% chance of economic trauma if the country doesn't change course. Stick around to hear Dalio's stark predictions, what other top investors are doing, and the key signs to watch for before things unravel.
Over the weekend, Dalio posted that the bill is expected to boost the debt, which is now the same size as GDP, to more than 130% of GDP, or $425,000 per American family in a decade. Dalio warned that, quote, unless this path is soon rectified, big, painful disruptions will likely occur. PIMCO CIO Dan Iveson was a bit more sanguine in our conversation before the recent legislation was signed. He said the risk that the market loses confidence in U.S. assets because of its debt load remains low. The firm had been cutting exposure to long-dated U.S. Treasuries, something Iveson said is because other countries' sovereign debt has at least as good of a rate than the U.S. and is running much more prudent fiscal policy.
If we don't see signs of attempting to get debt under control, those probabilities of a more crisis level type situation occurring will steadily go higher with time. And then again, when people worry about these tail scenarios, including PIMCO, we want to get paid a little bit more to combat against those types of risks.
Economists try to estimate how much investors will want to be compensated for longer-term risks like the federal budget and inflation, and that's something called the term premium. It's not a perfect statistic, and models tend to vary, but in January, the term premium hit its highest level in more than a decade. It's pulled back since then, but does remain elevated. Still, the bond vigilantes have been somewhat dormant lately, something Ed Yardeni has recently attributed to the prospect that a new Fed chair will lower rates and refinance the long end of the curve. To learn more about the potential market ramifications of America's debt load and dive into what it all means for the economy and international relations, check out our multimedia special report, America's Deficit Reckoning, at cnbc.com/deficit reckoning, or go by following and listening to the Squawk on the Street podcast, guys.
So is the thinking now that a Fed chair who is more dovish and cuts at the short end would inflame the vigilantes at the long end, or increase growth and help that denominator?
I think the vigilantes do see things that are, perceived as potential engineering or trying to kind of engineer your way out of a fiscal crisis or a debt crisis, and they don't take kindly to that. And so that's something that Yardeni has been writing about, this idea of, potential yield controls and what that might mean, and the risk of inflaming the vigilantes. But for now, they seem to be kind of in wait-and-see mode. I mean, the White House has made this case that growth will kind of be the solution here. So they're waiting for that. There's this argument that maybe tariffs will bring in some revenue. The Tax Foundation said that could bring in $2 trillion over the next decade, although those effects would be attenuated by some of the economic impact. So there's a lot of factors at play. There are a lot of variables that kind of muddle the picture a little bit right now, and that has kept the bond vigilantes at bay, at least for now.
The idea that if the Fed cuts rates a fair amount, it would just obviously be a direct savings to the federal government is really based on the fact that they still issue mostly on the short end. Right. So it's kind of like the math is pretty clear on that. Yeah. But the idea of terming out the debt is kind of wild anyway. The market doesn't have the capacity for us to just roll it into 10-year paper.
Right.
And by the way, the average rate being paid by the federal government right now is like 3.6%.
Yeah.
10s are higher than that already. So why would you want to term it out?
Yeah. Last year it was 3.3%.
It's going up, obviously, every day. But that's,
right.
Yeah.